You should be afraid, be very afraid, because your retirement savings will be flushed down the toilet if this stuff is allowed to continue. Anyone of good conscience needs to rise up and say, enough. This must be stopped. I'll become negative on gold when I become positive on fiat currency. I'll become negative on gold when you start to see sensible fiscal policy. I'll become negative on gold when they start printing money. Okay, right now, we're just getting more, and more of all that. So,
is the euphoric rally in the stock markets over the last couple of weeks coming to an end? Well, it's Wednesday, May 13th, and the S&P 500 is down nearly 2% on the back of higher inflation data. In fact, the CPI, headline CPI, is now at the highest level in 3 years. Now, we're going to break this down today and talk about what's next for inflation, the economic growth, Fed monetary policy, and much more. George Noble joins us today. He's a managing partner of Noble Capital Advisors, and he's going to break down all these topics and reveal what he hates in the stock market right now, what you could potentially lose your entire retirement portfolio, and what he does like. He is the host of the Best Income Ideas Online Summit, which is happening next week, May 20th. And he's going to reveal and give us a teaser on what the best income ideas are during this interview. So stay tuned. It's going to be a very exciting episode. This video is brought to you by and sponsored by Kalshi. It's a largest prediction market in the United States. And unlike a sports book, you're trading peer-to-peer and real-world events from economic data to political outcomes, and the price moves based on public opinion, not a house. Go to the link in the description down below and use code LIN, L-I-N. New users get $10 when they trade $10. And for example, if you put $50 down on the trade on the screen right now, which is the Fed decision in June, if you trade on the chance that they cut 25 basis points in June, which currently has a 3% chance, your $50 could turn into $1,500 if you happen to be right. So link down below, check that out. George, welcome back to the show. Good to see you again.
Thanks for having me again, David. Pleasure to be here.
Inflation jumped in April to the highest level in nearly 3 years. Now, today, oil prices rose again as hopes of an Iran-U.S. nuclear deal, well, not just nuclear deal, but peace deal, have faded, and the S&P is down about 70 basis points as we speak. The NASDAQ is down 1.5%. You and I were just talking about offline about how frothy things are and how frothy the tech sector looks in particular. Well, it looks like every single time we get any piece of news that may be bad for equities, volatility ensues. And I think volatility is the name of the game. Before we talk about volatility itself, let's talk about today's CPI print. What's your reaction to the highest level in 3 years? Break it down for us.
I try not to get too caught up in the day-to-day machinations of the market. My prediction of CPI is no better than anybody else's. And also the volatility is a tremendous distraction. Jay Pulaski, who I think you're going to have on next week, David, he had a great line last year when I interviewed him. He said his superpower is to ignore Donald Trump. And what he meant by that was it's not that he's pro-Trump or anti-Trump. It's just that the volatility engendered by the daily proclamations is so it can be so distracting, and the market has no institutional memory from one day to the next, that you really got to keep your eye on the big picture and try to ignore the shiny object, which is the daily volatility. So with that in mind, the market is it's no secret, over the last 6 weeks has had an amazing run. The statistics are, I need not recite, it's one of the best 6 months runs in the history of the stock market. I think we're in a very frothy period. Speculation is running amok. This kind of feels to me like last fall when we had a huge eruption of speculation and the market collapsed. Things are just incredibly stretched. The inflation number you asked about, I think there's more where that came from. We're just starting to see the impact of rising energy prices. My crystal ball on what's going on in the Mideast is no better than anybody else's. We'll get into more detail on that in a second. But I think, oil prices, we're looking at higher for longer. If we use a sports phrase, if we look at the over-under, I'll take the over. And I think it's very important, just because the bond market's starting to notice it now. And so that's one of the big risks for the market. So this CPI print today is just one piece in the mosaic.
I was just showing the screen here. CNBC did a good job posting the breakdown of the CPI. Most of the increase came from gasoline, as is expected. I'm just pulling up what happens if we strip away food and energy. So core CPI. Core CPI remains at 2.8%. And airline fares was the item besides gasoline that jumped the most. So maybe this headline inflation is just transitory and the Fed is not going to do anything about it. What do you think?
Yeah, well, also, again, if you drill down a little bit further, I think if you look at services, I think that's bottomed in the low threes, if I'm not mistaken. It's kind of a sticky number, and I think it's heading up. And so, if you were to look at the economy, and okay, look, you can get caught up. You can cherry pick this number, that number, but overall, it's kind of okay. With sticky inflation above three and rising, and the threat of the higher oil prices now. It kind of, whether it's inflationary or not really depends upon what the Fed does. If the Fed does not ease, and you have oil prices rising, that will be deflationary because it will force contraction in other areas. On the other hand, if the Fed prints, they ease, that can make it inflationary. And so I don't think it's helpful to get into an IQ contest about exactly what the CPI number is going to be. All right, but in my view, easing right now would be a huge mistake, because you have an emerging inflationary pressure to begin with. You've got incredible fiscal expansion, big tax cuts, and so it doesn't paint a pretty picture for the bond market. And
Yeah.
I don't know, David, right this minute where the bonds are, but we've seen the 10-year drifting up. I last looked, I think it was 440, 445, and more importantly, you look at bond yields around the world where you have, Japanese 10-year, like, I don't know, 29-year highs or some crazy number like that. You look at the bund yields, they're at, 20-year highs. So U.S. bond yields have been remarkably quiescent in comparison. And I'm not calling for Weimar type inflation or anything like that, but let's just say you think about it. I mean, with inflation 3 and change and rising, where you've got 7-8% budget deficits as a percentage of GDP. Imagine, David, you go into the bank, you're making five, you're earning 5 trillion, you're spending 7 trillion. You owe the bank 40 trillion. You've got 125 trillion off balance sheet liabilities,
Uh-huh.
and you ask the bank, will they please lend you money at 10-year for 4.4%? I don't think they would. I mean, I'm talking about the bond market, obviously. So I think bonds are mispriced. I think yields are heading up. And you combine that with the situation we have in the Mideast where nobody knows what's going to happen to oil prices. I've spent a lot of time on this. I mean, it's become a national sport to try to handicap how this is going to play out. And I think the Iranians have my 2 cents for what it's worth, and advice is worth what you pay for it, which is nothing. The Iranians have every incentive to keep doing what they're doing. Their leverage has never been greater. There's 1,600 vessels trapped in the straits, can't get out. They got their fingers on 20% of the world oil supply. The U.S. can't do a whole lot about it. We're trying to blockade them, which makes sense. And I know there's the idea around that eventually, the Iranian oil won't have any place to go, and they'll have to do something. So it's really a giant game of chicken. Who's going to blink first? And so neither side has an incentive to give in right now. And so I think where I come out on all this is I think this is going to go on for longer than people imagine. If we were in Vegas looking at the betting line, I would take the over on how long it's going to take to resolve. And I had a great guest on the other day from Hummingbird Capital who explained that for every day you have this impasse, it's going to
Yeah.
take 3 days to resolve it. And therefore, so the ship's already sailed, no pun intended. We've got higher oil prices baked in the cake. Whether oil prices, I know you've had some really smart guests on lately, whether oil prices go to 150, 200, I have no idea. But I guess what I would say, David, is, we're not in Kansas anymore. You can't have the Goldilocks back. That's not good for markets. And so you take the specter of sharply higher oil prices along with the rising cost of capital in the form of bond yields. And then you look where equities are valued. To me, it's a very dangerous situation. Now, I know the bulls will say, well, hey, George, one thing that's happened, I think it surprised all of us, the markets have done as well as they have, despite what's happened in the Mideast. And hindsight's always 2020. But to be fair, earnings estimates have, been going up, and that's been the main driver for higher prices. But I think we're getting to a point now where, or we've gotten to a point where the oil price market's starting to get the joke about oil prices. The market's starting to see what's happening to interest rates. And I think we're very stretched. I looked at some great data from sentimenttrader.com this morning, showed smart money versus dumb money. That's flashing red right now. I see some of the rampant speculation that's going on in certain of the momentum names. So I think you faded here. Last time I was on, I said it was a market of stocks. It's still a market of stocks. Emerging markets did well as we thought they would. Miners had a profit, had a correction, but now they're coming on again, still like SSRM. So there's a lot to do here. I would stay away from tech, just as I mentioned last time. Software, we said stay away from. It's too hard. I'd still stay away from that. So there's a lot to do here. I just think if you want to make a market call, which I don't like making, I think I'd sell it rather than buy it. But I think the real action still is trying to get the sectors right.
Yeah. Okay, this is just to highlight on my screen the significance of the conversation we're having right now. This is the U.S. 10-year yield. I'm going to overlay this with the WTI crude oil price. Perfect correlation. This is important because the 60/40 portfolio is basically now dependent on where the oil price is going. Now, you've worked at Fidelity before. You worked for Peter Lynch. Tell us about the relationship between the 10-year yield, line on the curve, and oil. Why does this even happen?
So inflation expectations have been remarkably well anchored so far. It's kind of funny how, we all know the Fed's spoken about their 2% inflation target, which I think they've missed now for 5 consecutive years. So it remains to be seen how well anchored inflation expectations, if they'll continue to be relatively well anchored. Aside from energy, there's also food prices. And as I know, you've had many guests on talking about, first you have the move in gold, and Michael Howell's been big on this, the move in gold, and then oil looks very cheap relative to gold. And then you go down the commodity chain, the food chain, no pun intended, and you get to the food stuff. So you start looking at, so maybe, to be fair, oil is a much smaller percentage. Energy is a much smaller percentage of the consumption basket than it was 20 or 30 years ago. So the inflationary impact directly to the consumer is not as well felt, is not as heavily felt as it was previously. However, energy does go into the production of a lot of products. And so, kind of funny how, despite the rise in oil prices, you look at all the quarterly earnings releases and what companies are saying, no one's really talking very much about the impact of rising energy prices. So I think we're just getting to that aha moment where this could start to have a real impact. I'm reminded of what something George Soros once said. And it went something along the lines of, you want to be with consensus most of the time. As tempting as it is to try to be the wise guy and call the top or call the bottom. But he made a really good point. It was something along the lines of, you want to figure out what is it that the market believes that you think is not true. But more importantly, when do you think the market will figure out that they've been had? And, there's this view about the place, the economy's fine, and about the oil prices, and that the energy prices will go back down. Like, you look at the forward, the back end of the curve, and as you know, it's been very well behaved. But I think the longer this goes on, that's going to start to get unhinged. And as you know, David, you've had some great guests on recently. We're just weeks away from some really bad stuff starting to happen economically. I mean, you've seen the reports already. Air India announcing the cancellation of all international flights, and I saw another thing from another airline this morning. It's starting to happen. And so I think we're at one of these crucial inflection points.
Yeah.
And the markets have been relatively relaxed so far.
This is a good question from a prediction market that's, I think, kind of gets to the root of the sentiment issue. This is a good pulse on sentiment reading. This is from Kalshi. It's a prediction market, the largest in the US. Will Bitcoin outperform gold this year? The majority of traders on this particular trade voted no. 36% think Bitcoin will not outperform gold this year. There's a number of ways to interpret this. Either Bitcoin being a risk asset, historically speaking, not outperforming gold, historically seen as a safe asset. People are now switching to becoming more defensive than cyclical. Earlier in the year, earlier in January, the odds were flipped, 76.
Right. Right.
Now it's back down to 36. Or another way to interpret this is perhaps gold has overtaken Bitcoin now and usurped it as the alternative asset du jour for a risk perspective. So gold is now a risk on play. There's two ways to interpret this. How are you interpreting this one?
Yeah. So the most important point I would make, again, I'm going to defer to our good mutual friend Michael Howe. Bank of China and most foreign central banks continue to buy gold relentlessly. You probably saw the data out yesterday. I think they bought like, oh, was it another 8 tons, whatever the amount was, in the month of, I can't remember, it was March or April. So the PBOC, they're buying gold, ain't buying Bitcoin. And it's true for a lot of other central banks. That's the first thing I would say. I think it's probably the most important thing. So despite the setback that we saw in gold and silver, that buying has continued. Now, we've had a good call on gold and silver and the miners over the last year. The last couple of months weren't so great, but we've killed it overall. I think basically what happened was, gold and silver, gold was doing just fine, thank you very much, up until the fall. And then Momentum Bro and Bitcoin Bro discovered gold. GLD and SLV became their new target of speculation. So it overachieved. I mean, silver got, I don't know, 100% above the moving average and blah, 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 blah. Got over its skis, became a risk on asset. All right, was it, as you mentioned in your question. I think those positions have been rinsed, and you're now free to move about the cabin. That being said, if we have a big dislocation, a big liquidity squeeze, and I'm sure you saw this, David. I didn't get to watch your show yesterday, but I'm sure you saw the bit about how I think the UAE was asking to borrow money from the U.S. And the UAE owns $95 billion worth of U.S. treasuries. So you say to yourself, why would they want to borrow money if they've got all those assets? Well, maybe it's because if they start selling the treasuries, it's not going to be so good for a bond market, and maybe the Fed and the U.S. administration doesn't want that to happen. So maybe instead of letting them sell, if they're having a liquidity problem, instead of selling their treasuries, and I'll come back to gold in a second, instead of selling their treasuries, lend them the money. And so what this gets to is if you start to see a liquidity squeeze, if you start to see real liquidity squeeze for a lot of these governments, and they have to start selling assets, you sell what you can, not what you have to. What's liquid? Gold is liquid. Okay. So that could pressure the gold price in the short run. However, I believe if this starts to go the wrong way, you're going to see a big monetary response from the from the Fed. They're going to print a lot of money. We're going to get the big E's. I know a lot of the gold bulls we've had on over the years believe this. I believe this. Okay. And so as someone once said, it's not prediction. It's not, is gold going to 6,000, 8,000, 10,000? I think it is eventually. But what one has to keep in mind is the path. How do we get there? And, gold got to 5,500, went to 4,100. We're now wherever we are, 47, 48 today. So maybe we have a lot of, fits and starts along the way. But if you're investing, and you're not buying zero DTE options on the GDX or GLD, I think gold and the miners and silver and the miners are going much higher. That's it. You asked about fidelity, you invest. You're not trading. Okay. Everyone wants to kill it every day, every week. That's not investing. That's just total speculation. So no, I think the outlook for gold and particularly the miners, I want to highlight an idea we gave last time, if you don't mind, SSRM. Absolutely destroying it. Stock's on like 7 times earnings now. It's crazy. Not even cash flow. But the real important story with SSRM, aside from the fact that they've got great, by selling their Turkish asset, it's now a pure North American producer. And forget about the fact it's on 7 or 8 times earnings. They're generating copious amounts of cash. They sold their Turkish asset for $1.3 billion. They've got a stock buyback out for, I think it's 10% of thank you for highlighting this. This was in a recent Substack we had. They're buying back, they've got $3 billion in cash. They're buying back, a ridiculous amount of the float. And as my good friend Zachary Marks, who I had on a podcast recently, pointed out, he said, George, if you look back at the Mag 7 over the years and why they did so well, of course, great companies, a lot of strong cash flow, rising profits, et cetera, et cetera. But on top of it, They were generating so much cash, they were buying back stock. And this is a very crucial point I want to make because you've had a lot of great precious metal speakers on your program, David. But one thing I don't think has been highlighted, when you look at the unbelievable amounts of cash flow that the miners are generating now, and you probably saw yesterday, Barrick was up like 8% or something like that because they had a great print and they announced a big stock buyback. You look at the tremendous amount of cash flow that the sector is generating, and they're not spending it. They're either buying back stock or increasing dividends. The de-equitization of the mining sector, the buying back of stock, what that does is supply demand situation for these stocks, just as it did for the Mag 7. I think the outlook is outstanding. I mean, so you have a stock like SSRM, so a single digit multiple. They've got ridiculous, 70% margins, and they're buying back stock. Like, what's not to like? So to me, I mean, stock's like 30 and change that, 33,
Yeah.
whatever it is. I think the stock could easily double in the next year, easily.
So this is from the Noble update. I'm showing this is a Substack that George Noble is authoring. By the way, do you own any positions in SSR mining right now?
Yeah, I'm long SSRM, and this is what you're showing here is in the paid Substack, the private Substack. There's a tremendous amount of content in the free Substack. There's also another publication. We have the Pod Street Week, which I'd like to talk about, but there's a lot of good content I give away here in the free Substack.
Is it just this miner? Well, not just this miner, but are you just picking, is this a bottom up analysis you're giving us? Basically, you're picking miners right now, or are you bullish in the entire mining industry?
Entire mining industry. The macro, try to use a three-legged stool approach here. The macro, which we need not rehearse. I think we both go to that church. The macro, very in favor of gold and the miners.
Yeah.
Technicals, this chart, you look at the chart here, that had a little bit of setback. It's now up and to the right. And the micro. All right. So, I think if you bought the GDX or GDXJ, you'll do great. But I also think it's possible to add significant alpha by picking the right stocks. And this is one of my favorite miners.
Okay. I've got to ask you, since we talked about frothiness offline, the GDX is up. Let me just pull this up here. It is up a lot in the last 1 year. I'll give you the exact number. Since exactly 1 year ago, and it's up more since 2 years ago, but just in the last year, it's up 94%, almost 100%. In comparison, the NASDAQ is up only, I mean, it's had a great year as well, but it's up only, I say a measly only 34% compared to GDX. Fantastic results for both sets of investors. But how do you discern whether or not, let's say, the tech sector is frothy and the GDX is not, given how far both of them have run up? And you talked about how SpaceX is just out of control right now in terms of hype. So just before we talk about SpaceX and the tech sector, if somebody asks you, George, the gold mining sector has already run up 100% over the last year. Why are you still bullish? Why isn't it overbought? How would you go about answering that question?
Yeah, I'd say a couple things. One, look at the valuations. That's the first thing. Two, David, while you got this, it's a great chart. Do me a favor. You should take that back a little bit longer. Go back like 5 years, because when you go 1 year, it doesn't, you got to zoom out, as our crypto friends would say. Okay.
Okay.
And I don't know. Yeah. And go back 5 years, 10 years, whatever. And I don't know, can you do a ratio on this one? I don't know if you can. If you could do like a 10-year chart, 50-year chart's no good. But if you do GDX divided by QQQ, and let's take it back 10 years.
Okay. Let's see if I can do that.
See if you can do that.
Yeah.
I don't know. Okay.
That's the ratio of the GDX over the QQQ.
Yeah. Okay. Now that makes it look too good, but let's do like 10 years. You're going back too far.
All right.
Do it like 10. Do it like 10 years instead of 20 years.
Okay. So
and you'll make my point. If okay, go back further. Keep going.
Yeah.
Let's do
2016.
Okay. So what's overbought against what? Okay. Now, admittedly, the tech stocks grow, and the GDX is just, they grow too. But in any event, I would argue, it is, as Yogi Berra famously once said, it was a Casey Stengel.
I love taking this apart and just getting you to walk me through this, because now viewers can see exactly how you think. But anyway, please continue.
Right. So it is true that in the last, year or so, gold mining stocks have absolutely trounced NASDAQ. But zoom out, as our crypto friends would say, you go back longer, the gold stocks have massively underperformed tech stocks. So that's number one. And to be fair, that was justified because tech stocks had far superior earnings. But now what's happened, because the gold price has gone up so much, gold mining earnings are coming on like crazy. I think you would probably agree. At least I believe, why I still like them. I think gold's heading higher. I think you probably believe that as well. Whether gold's going to, 6,000, 8,000, 10,000, I don't know. When people say, George, that sounds like a macro play. What would it take you to become negative on gold? I'll become negative on gold. I'll become negative on gold when I become positive on fiat currency. I'll become negative on gold when you start to see sensible fiscal policy. I'll become negative on gold when they start printing money. Okay, right now we're just getting more, more, and more of all that. So the fundamentals are getting better. One of the things I learned from Fidelity, Peter Lynch always would teach. I mean, don't just look at the price. You could buy a stock. Let's say you buy a stock at 10 because you think it's going to 15. And they have good earnings. And now the stock's 13. So if the fundamentals didn't change, you could say, well, at 10, there was a 50% perceived upside. At 13, if the target's 15, it's only 15% upside. But what if it turns out, David, that the company you're investing in, let's say it's a retailer, just picking an example, and it turns out their margins were better than expected. They announced more new store openings, blah, 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 blah. So all of a sudden, you say, you know what? My target on this stock's not 15. My target's 20. Stock's at 13. Stock's 12 or 13. It's got 60 or 70% upside. The upside at 12 or 13 is even more than it was previously when you first bought it at 10. So in other words, can you upgrade the story or downgrade the story? And I would say with the gold mining stocks, we're upgrading the story. The valuation, funnily enough, has contracted. P's have gone down. Earnings, and so relative earnings are accelerating. The valuation is cheap. They're under-owned. Wait for it. I know you know this, David, but if you go back and take a look at the holdings of the GLD, the gold, sorry, the ETF, they're lower now than they were 10 years ago when gold was much lower. So the public, this has not been fueled by widespread public buying. I mean, the Western investor has not been the one leading this hit parade. The price of gold has been led by central bank purchasing. And, I don't think this is going to end until the public's all in. So it's among energy and gold and the miners and commodities more generally. That's where you want to be. Or Dennis Gartman, who is retired, used to say, you want to own things which if you drop it on your foot, it will hurt. Okay. And I think that's the way forward in terms of what I want to own in this market.
More fundamentally, before somebody asks you, is this a macro play? Somebody might ask you, well, why would you allocate your capital to the GDX index versus the QQQ when one index, the GDX, for example, the entire valuation of the space is dependent on the price of a commodity, a yellow metal in this case, that you can't control, or the company can't control either, right? As opposed to the QQQ, which is composed of companies whose future is dependent on innovation in which they can control. I mean, isn't that just from a more fundamental perspective? As an investor, wouldn't you want to be in something? This is just, I'm playing devil's advocate here. Wouldn't you want to be in something? Put your money to work at a company that is able to have a lot more flexibility and control over the underlying fundamentals of the valuation of the company?
I think the context of that is an excellent question. I think the context is very important. If the thing they can't control is in their favor, then I'm all for it. Okay. We're talking about scarcity. Okay.
Fair enough.
Now, in actual fact, and I'm going to turn this question on its head. You look at the QQQ and you look at how all the hyperscalers and the chips, they dominate the QQQ. All right. It's kind of all the same trade. They're all dependent on one thing, which is the data center build out. All right. Going back to this line about Soros that I mentioned earlier, try to figure out what is it the market believes it's not true and when will they be had. I mentioned this, I believe, in our last interview. I think the numbers on these data centers just do not add up. You've already seen, I think, fully half of the data center announcements, data centers that were supposed to be built this year have either been canceled or delayed. All these chips are being bought, in anticipation of being put to work on data centers. To me, it's not, do I like AI or not like AI? It's not the question. As Peter Lynch would always say, the product is not the stock and the stock is not the product. All these companies, you want to talk about commodity? They're all taking all their cash flow and pouring into something which is a commodity. Okay, AI. All right. AI, yes, I use it, you use it. They'll have a lot of applications, but will they be able to monetize it to a degree that'll justify the current investment that they're making? And not only is, I'll put it mildly, not only is the jury out on that one, I'm highly skeptical. To me, right, yeah, it makes me more productive, but does it justify the trillions of dollars of investment that's occurring right now? I don't think so. And you look at a company like Oracle, where the stock is lower now than it was prior to that day back in October of last year, and they announced this incredible backlog. The Oracle CDS are going through the roof. There are real questions about the viability of what they're doing, and I think it's all it's going to take is for a data set for one company to pause or cut back on their spending, and you're going to see this whole thing go into reverse. And so it's funny. I think the tech stocks, it is a heterogeneous sector. That's true, but right here, right now, the thing that's driving them all, it is a commodity. It's one thing. It's correlated to one thing, and that's the data center build out.
Okay, I think this is a good time to pivot into talking about income ideas. So you have a conference that's literally called the Best Income Ideas Online Summit. It's coming up next week, May 20th. And this is a follow-up to the last conference that we talked about, which was a resounding success, but just by the guesses. And I'll review the guesses for this one coming up. But this one is called Best Income Ideas, as opposed to Best Stock Ideas, which was the last conference a couple months ago. Why the pivot in the name, George?
Right. So if you just click at the bottom here and scroll down, you'll see some of the speakers. These are a lot of folks that you know. This is really the varsity team. So the basic idea is in a world where, bond markets are challenged, inflation is rising, what is one supposed to do with their 60/40 portfolio? Bonds have been, I think, gone down for 4 consecutive years. And as has been highlighted in many of the shows that you've had, David, the outlook is not particularly promising for bond markets. So what does one do with the 60/40 portfolio? You think about the 60/40 portfolio. Historically, bonds have played a role in hedging you against an economic slowdown, recession, et cetera, et cetera. But that's not really the biggest risk right now that we have in markets. Instead, it's inflation, government spending is out of control, so on and so forth. And so bonds are not the right hedging instrument. Some have said, and I said this a year ago, sell your bonds and buy gold. Even someone like Michael Wilson, the head strategist at Morgan Stanley, has argued for a 60/20/20 portfolio. Take half your bonds and buy gold. Some have said buy oil. So the question is, what do you do with your bond portfolio? And for most investors, they do have a fixed income allocation. So what we're doing here is in collaboration with Seeking Alpha, we've taken some of the best thinkers that we know, and you've had many of these folks on your show, and I know you're having Jay Pulaski on next week, to set the stage for the macro picture as to why bonds, why the 64 portfolio is so challenged. So we're going to set the table with Michael Howe, Luke Groman, David Hay, Jay Pulaski, and then John Roque on the charts, everyone's favorite technician. And then from the Seeking Alpha side of things, Steve Kress is the man behind Alpha Picks. He's done an unbelievable job. Alpha Picks, since its inception 4 or 5 years ago, is trounced the S&P. It's up, I think, 400%. The S&P is only up 90. And you can get his product. It's transparent, it's scalable, it's repeatable. It's unbelievable how good it is. But in any event, Steve Kress is leading the contingent from Seeking Alpha. And if you just scroll down a little bit, you'll see we've got a whole bunch of folks from Seeking Alpha. Each of these fellows, Jay Mintzmeyer, one of the best shipping analysts I know, Michael Boyd on energy, all these fellows here, they each have their own products and they traffic in a lot of income names. So instead of owning the U.S. Treasury or a T-bill, maybe you own a Brazilian bond where you can get paid 14%, and there's a lot of scope for rates to come down, and their fiscal situation is a lot better, and the Brazilian real is appreciating. Or maybe you want to own Petrobras, the big state-owned oil company in Brazil, pays a nice yield and also is levered to rising oil prices, et cetera, et cetera. Or maybe there's a REIT which has a well-covered dividend, which in a rock-solid balance sheet where you can make 8 or 9%. So the whole idea is going to be, how can we enhance I'm not telling you to go short bonds. No, what I'm trying to do is come up with uncorrelated sources of income, all right, to replace your bond allocation. And the performance generated by some of these fellows is unbelievable. I mean, Sam Smith up 19% annualized, Jay Mintzmeyer 34% annualized. I mean, it's just extraordinary. And so this is an amazing group of people. You'll never find a conference with so many great speakers on one stage. And it's all for $99. I mean, David, you know a lot of these folks. I mean, so we're really trying to democratize finance and help people. And the last conference was a big success. We had over 800 people. I think we'll have a few thousand people. At least that's what I hope for this conference. So, again, May 20, David can help you buy tickets if you're so inclined.
Yeah, tickets link down below. And I want to just come back to this conference for a minute. But before we do, you mentioned something that made me think. Maybe the silver lining to this higher inflationary world that we're talking about right now, maybe the silver lining is that in the future, if bond yields go up, investors will have a higher chance of seeking yield in just normal products. But by normal, I don't mean going high yield or going into some advanced options or derivative strategies. Just you find a T-bill, perhaps they'll just beat inflation and your real yield is going to be higher than it was a couple of years ago. Maybe that'll be the future. I don't know. Speculating here. Hopeful.
David, from your mouth to God's ears, by suppressing the cost of capital, I believe below the neutral rate. I think rates should be much higher. What that does, and Louis Gabb was a good mutual friend. Louis and Charles have spoken about, when you suppress the cost of capital, that encourages more speculation and in turn leads to the hyper financialization of the economy, companies engaging and leveraging up and buying other companies, doing M&A instead of building productive assets. And so, yeah, it's all great. Everyone loves the fact that their IRA goes up in value, the stock portfolio goes up in value. But the societal impact of all this, we all bemoan the hyper financialization and the disparity in wealth between the have and the have-nots. The guys who own the assets are doing just great. But if you're unfortunately, in the top of the K-shaped economy, one of those who doesn't have a big portfolio, you're on the wrong side of this because you can't afford stocks. Real estate assets are too high. The cost of housing is too high. So I think higher interest rates, rather than being feared, they're actually lower rates are actually the problem. Higher interest rates would lead to a better rebalancing of the economy. The problem is, in so doing, it's going to cause a dislocation. Some of these highly valued assets are going to take it on the head. I saw something yesterday. It said that 75% of the implied value in the stock market now is based on future value. And what they mean by that is it's not like a PE on current earnings or dividend yield. It's like how much of the valuation is a discounted cash flow of stuff which is way out in the future, which may or may not materialize. All right. I happen to believe it's not going to materialize. And so it's setting up a very dangerous situation. I don't know if semiconductors made their peak yesterday or they're not going to peak for another 3 months. But to use the basketball analogy, buying semis right here, right now, it's like taking a 3-point shot 10 feet behind the line. It might go in. It might go in, David, but I promise you take that shot 10 times. You tell me how many times it's going to go in. You might get lucky once. And so, look, the future's unknowable. We can't predict these things with any precision. But what we can do is evaluate risk. Like, how much risk am I taking by buying? And that goes to the valuation. How much risk am I buying by buying a certain asset here at this price versus, juxtapose semis with oil? Oil, the energy stocks, you look at what's implied, they're assuming the oil price is going to go back down. They really have not taken on board the idea that we could have higher oil prices for longer. The semis, on the other hand, people say, well, look at the PEs, look how low they are. That's a very myopic, theoretically incorrect way of looking at the stocks. So you think about what a PE is, it's really a shorthand for discounted cash flow. So yeah, it's true, Micron, SanDisk, whatever, they're going to kill it with earnings for this year, next year, maybe a third year. But the pricing is so high now that the way capitalism works, it's inevitably getting a lot more supply. And I'm of the belief that earnings are going to be a lot lower 3 or 4 years out. But people aren't looking at that right now.
I've had the pleasure of interviewing 2 of your guest speakers already. Luke Groman and David Hay have been regulars on my show. Jay Pulowski, I'm going to have next week, and then yourself. Some of these, just talking to Luke and Dave, I'm getting the vibe that some of the themes of this particular conference will be about allocating outside of the U.S., given how dollar debasement and fears of an entrenched inflationary environment would erode confidence in fiat assets. Is that am I on track here, George? We don't have to give away the entire
100%.
conference, but I think that's
David, next time we do this, I got to make you the keynote speaker.
no. I
Michael Howell's the keynote speaker, but you got it nailed. You're exactly right.
Okay.
You're exactly
What
right.
else can we expect? So we've got some sectors that investors can gain insights from. You've covered nuclear on your own Substack. You've covered mining. What else? What other sectors can investors learn more about at your conference?
The conference is going to be all about income. So it could come from a variety of sectors. So, like,
Okay.
while I'm not a champion of the REIT sector, if there's a well-covered REIT, which is, sorry, a REIT with a well-covered dividend that's not exposed to the CRE debacle. Like, let's say it's something that's not economically sensitive. I don't know, nursing cares or something like nursing homes. So I expect we'll have some ideas like that. Again, it's uncorrelated alpha, it's uncorrelated sectors. So I think what's really important is not so much the sector, but more it's the factor. We want something which has a good yield, where the dividend's protected and growing. So, like in the case of an energy stock, or say you had a gold royalty company, the income would go up as the price of gold goes up. All right. So it's going to be across a multitude of sectors. I think it's going to be uncorrelated. And so this will have a vastly superior yield, can be a huge yield pickup versus treasuries. And you're going to be protected against inflation. So to me, it's a
Hmm.
slam dunk. I don't actually
Okay.
know all the names. I don't want to know
Yeah.
all the names.
Sure.
But but if I look at the body of work that these guys have put together, it's really very solid, and their track records speak for themselves.
George, let me finish off on, by the way, link down below. Please do check out the Best Income Ideas Summit. Monday, sorry, not Monday, May 20th. So that's exactly 1 week from now. I believe it's a Wednesday.
Wednesday, May 20, 8 days from now.
All right, George, what do you not like? Let's close out the conversation. We've talked about things you do like. What do you not like right now?
So I would avoid highly speculative companies. I'd avoid companies with bad balance sheets. I'd avoid companies levered to the consumer. Let me name names. One of the outstanding picks we had from the March conference, Tom Chanos. He recommended Fresh Pet. Okay. Everyone, most people like dogs, own dogs, whatever. I own a dog. And Fresh Pet, they're the ones with the refrigerated dog food in the store. Fresh Pet has pretty much exploited all its growth potential. They're in most of the Costco's and the Walmarts. So Tom recommended it as a short at 80. The stock's like 50 or 52 right now. It's down 30%. But I'm telling you, and Peter Lynch would say this, don't result on price. I said to you before, even if the stock goes up and the story's getting better, you might want to own it. In this case, even if the stock is going down, doesn't mean the short's over. In fact, I think, it's down 40%. I think it's going to fall another 40% and another 40%. Why? Fresh Pet this is like the week or two after Tom recommended it. Costco, which is 10% of their revenues, announced their own product. They've come out with a Kirkland brand of pet food. I already saw it. I went to the store. And then Walmart, which is 35% of revenues, they also came out with their own product. And not to mention General Mills has a competing product as well. So Fresh Pet, the stock's 80 to 52, wherever it is today. I think the stock over 15 or 20 bucks. So I think stocks like that are terrible. I'll name some other names. So Fresh Pet's one. I think Kava, which we all know, the salad guys, stupid 30, 40 multiple, like for consumer stock in this environment, you're freaking crazy. Hood, which exploded last year, largely on the back of all their crypto activity. That thing is imploding. I'd avoid the semis, and so I would short Hood. I am short Hood. I would short Fresh Pet. I would short Kava. I would short Tesla. One thing on SpaceX. SpaceX, as crazy as Tesla is, I think Tesla's worth $50 a share at most. It's like
Would you
420
buy the
right now, right?
SpaceX stock? Would you buy the SpaceX stock
Absolutely.
once
I
it
would run,
IPOs?
not walk, run, not walk as fast as I can from SpaceX. 15 billion in sales, losing money. They want to bring it public at 1.7 trillion. You look at how the private market valuation of that thing has been walked up the last couple of years, 200 billion, 400 billion, 800 billion, trillion seven. Okay. SpaceX, and let me get on my soapbox right here now. SpaceX must be stopped. And it's not about, it's not, I don't have EDS, I don't have Elon derangements. No, it's nothing about that. We're talking about a misallocation of capital, the destruction of price as an important signal to allocate resources, the manipulation of the index so that it's going to have 5 times the weighting in the index as it should, 5 times the amount of its float. This is a watershed event for our markets. I think it's going to be an epic bust. I think people should run, not walk from SpaceX. It's great. I mean, it's hopium though. All right, there's no cash flow here. It's a disaster. And one thing on Tesla, as long as I'm on, I want to point out to you how broken markets are. Tesla has a market cap today of about 1.5 trillion, give or take. In the entirety of its existence as a publicly traded company, or even before it was public, it's only ever made $38 billion total. And that's despite having received over $20 billion in government handouts, emission credits, so on and so forth. Yet, it's worth $1.5 trillion. They're going to have a third consecutive year of declining revenues. People say, well, George, it's not an auto company. Oh, really? Okay, let's not put a label on it. 87% of its revenues come from auto and auto related. David, if you do want to call it something, the auto company, be my guest. All right. And all the other businesses, the robots, the self-driving cars. Elon Musk admitted 3 weeks ago on the call, it ain't happening. It ain't happening. The robots is a make-believe pretend thing. All right. The whole thing is worth maybe $50 a share, and it's at 420. And now, people say, well, they may merge SpaceX with Tesla. There's an argument to be had that the SpaceX IPO won't even ever happen. It's a whole other story, which I don't want to get into right now. But I think it's not about Elon Musk. Let me just finish here, David. It's not about Elon Musk. It's not about Donald Trump. It's about corrupting the integrity of our financial system. It's about, David, as an American. I don't think most of your viewers are probably American. The idea that you're going to have some percentage of your net worth in your pension fund invested in a piece of garbage like SpaceX, which is 120 times revenues because they got put in an index. I mean, what are we doing here? Is that in society's best benefit, best interest? I don't think so. So run, don't walk as fast as you can from SpaceX.
I'm just Googling actually right now because I don't know this number off the top of my head. How many years did Tesla lose money? According to New York Times, Tesla lost money for 18 consecutive years from its founding in 2003 until it's finally recorded its first year net profit in 2020. And then the stock soared from 2020 to from $34 a share to more than $200. Basically, you lost money for more than a decade, yet people still bought into the dream and they made a lot of money. So what you're describing is true. I understand the argument, but
And David, some people would say, that's the past. This is about the future. This
yeah,
is it's Tesla's X growth. All right. The earnings have been collapsing. Earnings estimates on Tesla have gone from $8 to $2 over the last 3 or 4 years. Peter Lynch, please call your office. Okay. He would always say, you tell me the company's going to earn, I'll tell you what the stock price could do. Okay. To me, Tesla is the biggest misallocation of capital in the history of markets. The product is the stock. He's selling hopium. The fact the stock is where it is has nothing to do with the profits of the car. It's all about dreams. Okay. And this is more than just of academic interest. It's not just, oh, Elon Musk is making me. No, we are talking about corrupting our entire capital markets. This must stop. This will stop.
what have I told you? Let's flip this around. Earlier you said, look, even if the company's fundamentals are based on a commodity that they can't control, if it's in their favor, why not look into it? You're talking about the gold mining stock sector. Okay, well, if SpaceX has the same kind of model as Tesla, meaning it's selling hopium, the pay package of Elon Musk, $1 trillion if he puts people on Mars, if the entire grid of if the entire uh, g- energy grid built in space generates more electricity than the United States. I mean, that's basically the number. And that if those conditions are met among several others, he gets $1 trillion as a compensation. Okay, so people want to have this dream that society advances beyond coal and fossil fuels, and we're all living on Mars. We're living in space stations, and we're able to generate electricity in space in giant, solar panels. That is going to what ultimately drive up the stock price, not the fact that it's making money or losing money. Your response?
So Peter Lynch, I wish Peter was here. He would always say, "You tell me the company's going to earn, I'll tell you what the stock price would do." He would always pull out a long-term chart book, pull up a classic example. He'd always reference Coca-Cola. Coca-Cola went up like 30x over a number of years. Well, guess what? The profits went up 30x over a number of years. Okay, as Warren Buffett famously once said, "In the short run, the stock market's a popularity contest. In the long run, it's a weighing machine." All right. This is sheer hype. You have a whole generation of investors who've been investing only since post-COVID. I'll put it charitably, they're not as expert in financial analysis and as valuation as they should be. All right. Yeah, it's cool. We got these rockets you can reuse, but that's like a publicly traded science experiment. Where's the money? Where are the profits? Okay. You want to talk about electric cars and self-driving cars? All right. I believe eventually, maybe 5 years from now, yeah, we're going to have self-driving cars. And you know what, David? Everyone's going to have them. And it's going to become commoditized, just like a GPS is commoditized on your car right now, right? And guess what? Nobody's going to make any money out of it, right? It's going to become a commodity, all right? People have lost their mind. And, Musk is guilty of legal fraud, if not outright fraud. The accounting has been atrocious, all right? And the feckless SEC is MIA. They're nowhere to be seen. And so he's getting away with all this stuff. And so I'm telling you, investors are going to get an education. And as my father would say, you can get it by precept, I read about it, or by experience. All right. And the last thing I'd like to say to you about Tesla, despite all the hope, or the hopium, it was a great stock up until I believe the end of 21 or 22. All right. Do you realize, despite all the hype, Tesla stock, no one's made any money in Tesla stock. It's unchanged over 4 years. Tesla is going, mark my words, is going to be the biggest example of capital destruction in the history of markets. Another thing too on Elon Musk. Yeah, people say, wow, it's great. Look what he's done. No, the stock's gone up. All right. He has destroyed capital. I'm not talking about the price of the stock. I'm talking about, does Tesla earn its cost of capital? No, they destroy capital. They destroy capital. If you say, okay, you look at their cost of equity, cost of debt, whatever, they have a 7 or 8% cost of capital, whatever the number is, okay? They have destroyed capital. They have cost the governments tens of billions of dollars. And for this, the guy gets to be the richest man in the world? Like, hello? So all this stuff, people are bamboozled by, oh yeah, we got the boring company, we got solar panels. Data centers in space, are you crazy? Talk to one physicist. That's not a thing. But people are buying the bullshit.
I get your point. I get your point. First of all, yeah, the Tesla stock hasn't done well the last couple of years, but it's still near all-time highs. What is wrong fundamentally? Let's move away from Tesla and SpaceX.
Sure.
What is wrong with buying the hype? You just gave me every single reason for the market to get into this stock. Maybe they're doing it for the wrong reasons, but who cares if it's for right or wrong reasons? I mean, I'm not judge or jury on what is right or wrong.
Sure.
I'm just following the trend, and you're telling me there's a whole generation of people who's going to buy into the hype. Why not follow that herd? And we'll close it here.
I think it's a great point you make. Mm-hmm. And some might say, well, George is grandpa, go back to the retirement home. George is a boomer, blah, blah, blah. Okay. But I would say to you, David, look at the Hall of Fame of greatest investors of all time. I don't care who you want to pick on. You can pick your list. I'll pick my list. All right. Show me one who made his fortune chasing hype. Because at the end of the day, if the hype does not translate into profits and cash flow, it's a big circle jerk. Okay, it's like, so David, you want to do the Chuck Prince shuffle and play the greater fool theory? I got this. Don't worry, I'll sell before everyone realizes they've been had. Right? That's not the way I roll. It's not the way Peter Lynch rolls. Julian Robertson, Stan Druckenmiller, George Soros, Ken Griffin, Steve Cohen. No serious investor manages money that way. It's only idiotic furus on X who thinks that's the way you invest. And Elon Musk is exploiting those people and taking advantage of people. And we have a government. This is not a political statement. They've defanged the SEC, and he's not held to account. This is. I'm telling everyone who's watching this, you should be afraid. Be very afraid, because your retirement savings will be flushed down the toilet if this stuff is allowed to continue. Anyone of good conscience needs to rise up and say enough. This must be stopped.
Well, how do you suppose the markets or we stop this, George?
Well, you know what usually happens? Things don't go down just because they're overvalued. It's not the way it works. They go down because you need, it's change at the margin, change in expectations that causes things to influences prices. All right. So, for instance, okay, I don't think Tesla is going to be more or less break even this year. It's going to be a third declining year of deliveries. And here's the interesting thing. They're spending so much on CapEx because of the whole data center thing. They're going to be seriously cash flow negative. They've guided to capital spending of $25 billion. I don't remember exactly from memory. I think the depreciation is like 8 or 10 billion or something like that.
Yeah.
So they're going to be seriously cash flow negative. They may have to issue equity. That's one possibility. The other possibility, go back to what we were talking about earlier. All things being equal, which they never are, if interest rates and bond yields continue to go up for all the reasons we discussed, that's going to particularly hit the long duration assets, the most expected, the most high PE stocks. All right. So that's another reason why it might go down. SpaceX, if it does come public, that's going to draw a lot of the interest away from Tesla, because a lot of the sex, drugs, and rock and roll, the data centers in space and all that nonsense is in SpaceX, not in Tesla. And some would say that Musk's attention is shifted from Tesla to SpaceX. So there are a lot of things I could see happening that's going to cause the Tesla stock to go down. And,
Okay.
and in the meantime, in the run up to the offering, the IPO, which is supposed to come public next month, Tesla stock may get dragged up. But again, the last thing I would say on this, stock prices follow earnings. That's the way it works. With Tesla, there's been this unbelievable disconnect. Maybe Tesla is the exception that proves the rule. I will bet my bottom dollar that this robot thing, this self-driving thing, not happening. Not happening. And even if it does, we did a sum of the parts with Gordon Johnson. We took Tesla apart and put a valuation on the energy business, the car business, the robots, all this stuff, right? You can't get to more than $50 a share. But you try to discuss facts and numbers with the fanboys, all they come back is with insults. You know, I put up one post. I put up two posts. I'll stop with this. I keep saying I'm going to end with this, but you triggered me, David. I had a couple posts 2-3 weeks ago. They each got over 1.5 million impressions. Some rando guy in Westchester, me, got more impressions than the Washington Post. I did one on SpaceX and one on Tesla. And the incredible thing was, we took apart Tesla piece by piece. I got thousands of replies, thousands. There was not one reply of substance citing numbers. They're all going on about the rockets, and you must be a libtard because you hate Musk politics. It has nothing to do with it. People don't know my politics. I'm anything but a libtard, to be quite honest. No, there was not one response of substance. You know, go back to Fidelity again. There's not one response. And I defy anyone watching this podcast. You would not even get an interview at Fidelity. You'd be thrown out on your ass. This is Captain Obvious retail hopium. All right. Anyone who's financially I'll say, I'm going to trigger people. They're going to get pissed at me. Okay. It takes a special type of financial naivete. I'll clean it up. It takes a special type of financial naivete to own Tesla. Or if you want to go to David Lynn's school of investing, if you be serious, you want to play the momentum game in greater fool, have at it. I'm all for speculation, but don't you dare pretend there's anything fundamental going on here. You've triggered me, David.
Yeah. Good. No, this is exactly what we want. And to be clear, it's not my school. It's the school of hard knocks that people have to play sometimes. But and
David, look, don't get me wrong. I got run over shorting Tesla. I've made some money. I've lost some money. Net, I've lost some money shorting Tesla. Okay. But I'm putting truth to power. Whether the stock ever converges to fair value, and I say fair value, it's real simple. I'm just competing against other companies. I don't know. Again, David, Tesla's worth more than the entire rest of the auto industry put together, and they got declining sales. Does that make sense to you?
Yeah, that okay, I hear you. I just wonder why that I just wonder why the stock has been trading the way it is for so long, even though those fundamentals you talked about have been a fact for many years. I mean,
Sure.
it's the last fact I'll indicate the last stat you gave me, right? It's had high valuations higher than a lot of other auto stocks
Hey,
put together, and it's not even making as much money. That how does that even happen when you think about it? Like how?
again, in the short run, markets are a popularity contest. Markets are a popularity contest. The long run, it's a voting machine, and this short run's gone on for a very long period of time.
Yeah, the short
Don't
runs
listen
have
to
been a
don't
long run
listen to
now.
me. Listen. If someone goes and wants to buy Tesla now, have at it.
Yeah, sure.
Okay, just realize what you're doing. And my fear is, another thing too. I'm shocked by the quality and the knowledge or lack thereof of so many replies I get on X. People just they don't know, they don't even know that the company's selling on a zillion times book, a zillion times earnings. It's unbelievable. Unbelievable. So I just think there's a whole generation of investors who drank the Kool-Aid. The market is a popularity contest in the short run. Elon Musk is a master carnival barker. Okay, he's engaged in legal fraud, been economical to the truth, shall we say? All right. I mean, David, let me ask you something. If I came to you 10 years, every single year said to you, oh, we're going to have self-driving cars by the end of the year, self-driving cars by the end of the year, self-driving cars at the end of the year. Forget about whether you're going to call me a liar or not. But the 11th year I come to you and say that, would you kind of like maybe not want to believe me?
I have to consult a psychologist as to why people still buy into this. I understand what you're saying. If you did that to me personally, we wouldn't be friends anymore. But if you were Elon Musk, I probably, somebody would probably, that person would still buy your stock. And I can't give you an answer as to why that is. Maybe they believe something else is bigger and more important than the self-driving car aspect. I don't know. I don't know.
Yeah.
I
But
mean,
anyway,
there's a lot of liars in
let's
power. Let's leave it here. There's a lot of liars out there in power. Doesn't matter where you look, but it seems to me that people overlook some of these facts that you've given. Where can we follow you and learn more? Like I mentioned, your Substack.
sure.
Do
Yeah.
follow
So we're
George's
on the
conference
Substack.
down. Yeah.
We're on X with G Noble 79. And David, thank you for putting the conference website up, noble-capevents.com. Okay. And $99 next Wednesday. Replays will be available to everyone immediately. So I don't expect anyone to sit through 8 hours of it, and you can watch it in pieces. It's going to be fabulous. If you're serious about your money, and honestly serious about your money for $99, you're never going to find a better conference. So come and learn. Come and learn.
All right. All right, George. Thank you so much. We'll put the links down below. Follow George there. Take care for now. See you next time. Thank you for watching. Don't forget to like, subscribe.